So the rule that locked some traders out of the market for the last 25 years, good news, it's gone. And barely anybody knows it even happened. And that's what I'm going to tell you today. So the $25,000 pattern day trader rule is getting removed. So that means no more counting your trades, no more automatic PDT label because you made a fourth day trade inside 5 business days. But there's a catch that many people also don't know, and that's that some brokers have already changed. Others may not change it until late 2027. So I want to explain to you what the old rule did, what replaced it, and why more access does not automatically imply easier money. So online trading was just exploding. The dot-com bubble came and it collapsed. And then the retail traders lost serious money and trading commissions were getting higher and regulators wanted a simple way to control the risks of frequent leveraged trading. They built a wall. So if you made 4 or more day trades within 5 business days in a margin account, your broker could classify you as a pattern day trader. Once that label hits, you generally needed at least $25,000 in the account equity to continue day trading. So think about how odd that was. You could study the market for 5 years, manage your risk carefully, and have $24,900 in your account, and that rule treated you as unqualified. However, somebody hits $25,010 could technically place more trades even if they had no plan, no discipline, or bought every stock a guy on TikTok said. The rule measured your account size. It didn't measure the quality of your decisions, your skill. And almost every small trader knows that feeling. You enter a trade on Monday, another Tuesday, and close something Wednesday, and then suddenly you're doing mental accounting. Was that my second trade? Was that my third? Can I exit this position today? Or will selling it trigger the fourth? People weren't only trading the market, they were trading around the rule. Now, once that's flagged, accounts could face restrictions. Under the old system, failing to satisfy certain trading margin calls could leave your trading only available cash for up to 90 days. That's it. And that fear kept a lot of traders frozen. Then on April 14, 2026, the SEC approved FINRA's new framework. The change is effective on June 4th. That pattern day trader designation was eliminated under the new system. So the fixed $25,000 minimum for frequent day trading was removed. And brokers adopting the new framework no longer need to count their trades to determine whether they crossed an arbitrary line. So what replaces it for you? Intraday margin. Now that sounds complicated, but I'm about to explain this to you. It's easy to understand. The basic thought of it is simple. Instead of asking yourself, how many trades did this person make? Your broker can ask, how much risk is this account creating right now? Your buying power can now be based on actual positions, account equity, maintenance margin requirements, leverage, and any intraday margin deficit. Okay. Now, for those of you who want to get a little bit more technical, it's basically risk is measured through live exposure, leverage, concentration, equity, and maintenance requirements, not some arbitrary trade counter. A more logical way to supervise risk. A trader holding one massive, concentrated, highly volatile position may create more risk than someone making several small, tightly controlled trades. The old rule often created them backward. But now we need to discuss the catch, because this is where social media will get the story wrong. June 4 was the effective date. It was not a magic date when every broker in America instantly changed its software policies, margin systems, and customer accounts. Brokerage firms have a transition period through October 20, 2027. That means one broker may have already removed the PDT designation, while another may still display the flag or operate under its existing implementation schedule. So Schwab, for example, stopped counting day trades in margin accounts on June 8th. Your broker may do it another way. So if you open your app and you find that there's a PDT warning, that does not automatically mean the rule change was fake and I just wasted a few minutes of your day. It may simply just imply your broker hasn't completed the transaction. So ask your broker when it plans to adopt new intraday margin framework and how it calculates your buying power. And then you understand three important things. First, that this applies to margin account rules. And two, cash accounts were never governed by the PDT designation in the same way, but cash accounts still have settlement requirements. Three, you cannot continuously recycle unsettled proceeds without potentially triggering violations and restrictions. Four, margin is still margin. Five, borrowed buying power can increase gains, but it can also accelerate your loss. So your broker may block a trade, reduce your buying power, liquidate your position, or require additional funds when an account creates a margin deficit. Removing the $25,000 wall does not mean every account suddenly receives this unlimited day trading power. If you have an eligible margin account, you still face minimum equity requirements and broker-specific risk controls. So under that new system, any eligible account with more than $2,000 may require intraday buying power, but the exact amount depends on the broker and the positions getting held. So what does this mean? That the access is changing, but the skill isn't. And honestly, this change may hurt some traders before it helps them. It's not that complicated because the old limit forced people to slow down. Now a trader with no process may be able to make more decisions and therefore make more bad decisions inside the same afternoon. More trades doesn't create more opportunity when you can't identify a valid setup. They create more slippage, more emotional decisions, and more chances to revenge trade after making a loss. That barrier is disappearing. The market is not becoming more forgiving. You still need rules for entries, position sizing, invalidation, profit taking, maximum daily losses, and knowing when to stop trading. You also need to understand what's driving the market beyond 1 minute, 5 minute candle. Interest rates, liquidity, currencies, geopolitics, government policy, capital flows, China, commodities, semiconductors, crypto can all change the environment surrounding a trade. And that's what we work on inside our community. We're not telling people that one rule change can suddenly make day trading easy, because it doesn't. We help traders to build a process, understand the larger market picture, study risk, and learn alongside experienced analysts and traders. Right now, you can receive 12 months of access to our research in our community for the price of 10. That gives you a whole year to stop just looking at headlines and not understanding what's going on and start building a repeatable way to interpret the markets. The $25,000 wall is coming down, but the people who survive will be the ones who respect risk, control themselves, and continue learning after everybody else gets overexcited. This content is all for educational purposes only and not financial advice. Trading and margin involves substantial risk, and you are responsible for every decision you make. Link in our profile in the description. Get a 1-day free trial. Join us today.